pointing out, Fitch has downgraded U.S. credit ratings. So Abhilash Narayan is here with us. He's Senior Investment Strategist at Standard Chartered, and he joins us now to take some questions. Abhilash, thanks a lot for joining us today. You know, we saw this news come through overnight. Of course, this is something that, we've spoken about for a while. It's no new information in terms of nothing has really changed, right? In the US, we did get this downgrade come through. But do you think this will be used as an excuse, like we were talking about, to sort of sell and give up some of this big rally that we've seen in the US markets?
Yeah, absolutely. I mean, if you think about the downgrade from Fitch, the factors that they mentioned are well known. And, the timing of the downgrade was a bit of a surprise. Now, I mean, it's interesting to see the reaction across equity markets and other asset classes. So we've seen, Asian equities decline since that news came out. People are using that as an excuse to take profit. But if you look at US assets, right, they're rock solid. 10-year Treasury yield has barely moved. If you look at the dollar, it's down only, very, very marginally. So the US assets, which should be more impacted by this announcement, are not reacting as much as what we're seeing in Asian equities. So seems like an excuse for profit taking.
Abhilash, could you jog our memory what happened way back in 2011 when the S&P had downgraded the sovereign rating? What was the market reaction then?
Yeah, absolutely. And that's a great point, right? So the market reaction we're seeing right now is quite different from what we saw in 2011. So back then, once we got the news of the downgrade, obviously we saw equity markets sell off. But we also saw the dollar strengthen and 10-year Treasury yields decline because there was a risk-off environment. And, ironically, as it may seem, US government bond yields declined. And dollar strengthened despite the downgrade. I think it's important to note the key difference this time around. So back in 2011, it was the first instance of a major rating agency downgrading US. So that really came as a shock to the market. The recent downgrade by Fitch, while it's a surprise, but I think the market impact is going to be more muted because US has already been downgraded by one agency. So one more rating agency downgrading it doesn't necessarily move the needle.
But maybe it does give that excuse to lighten positions a bit. I guess markets were just looking for that excuse, Abhilash. Now, the question is, what should one be doing as this plays out? Do you expect this to last a while, or do you think this will be a very knee-jerk sort of a one-day event? And within that, what would you do with a market like India?
Well, from a global perspective, the profit taking could extend for the next few days. Obviously, we've seen a very, very strong run up in equities over the past few months. So from a broader investment perspective, it does make sense to lock in some of those profits. In fact, we think that with 10-year yields being at 4% and a change right now, it's a great time for global investors to lock in or add exposure to high-quality US and European government bonds. Now, as far as Indian equities are concerned, we think that, yes, we will see a bit of profit-taking, but on a 6 to 12-month horizon, we still see a fairly high likelihood of Indian equities outperforming global equities, driven by strong domestic growth, as well as robust earnings, in our opinion.
Abhilash, do you think that with us seeing some profit taking in the US, and could it mean maybe a little bit higher flows for the Indian markets, for the emerging markets overall? And within that, how do you think India is positioned? Because we have been talking about what's really going on with China, with the economy there, with Hong Kong as well. How do you think the flows for India could really shape up from here?
Yeah, that's a great point. So from our perspective, obviously, we see India and broader emerging markets benefiting from rotation out of US equity markets into emerging market equities, given the fact that while in US people are concerned with the recession, we just saw PMI data overnight in US being quite weak, which just reinforces the economic slowdown. So all of those concerns are there, whereas in Asia, in India, economic growth is quite robust. Now, given what's happening in China, obviously, there is an argument to be made that, you could see some outflows there. But we think that the chances of outflows happening from China are relatively muted because investor positioning is quite light, and Chinese equities are trading at a 35% discount to global equities. Indian equities, on the other hand, have stronger fundamentals, but we all know that valuations compared to the rest of emerging markets are at a premium. So, net, we think Indian equities should outperform US equities, but maybe they'll perform in line with the rest of emerging markets.
Just getting back to the US markets, Abhilash, do you think there are any investors who would be forced to sell down Treasury securities because of the downgrade?
Yes, I think that is the big question out there. So yes, with two rating agencies having downgraded U.S. Government bonds to AA+, it's not in the AAA bucket. So you could see a bit of readjustment there because of some forced selling. But we think that the magnitude of that will be limited because at the end of the day, U.S. Treasuries are amongst the highest yielding bonds when you think about developed markets. So the cost of reducing exposure to U.S. Treasuries from a carry perspective will be quite steep, especially when you think about the fact that German bonds are offering much lower yields. So yes, there will be some rebalancing, but we don't think that it will necessarily move the needle for the markets.
Now, Abhilash, just to get back to the point that you made, that investor positioning is much lighter in China, and that's exactly the thought that I've been having for the last several days. As this money rotates out of, say a market like US, will China be a better home because of the fact that the market has underperformed, whereas we here in India are sitting at 19 times forward earnings? Is there a re-entry China trade in the making that you see?
Well, it could happen, but we wouldn't go in a material way right now. And the simple fact is, right, if you look at Chinese equities, they are trading at a discount for some good reasons. I mean, the economic sentiment and the investor sentiment has been scarred given the policy actions that we've seen over the past couple of weeks. So we really need to see first a stabilization and then a rebound in economic growth for investors to gain confidence that the measures that policymakers have taken are actually leading to the desired outcomes. So for now, we think that India and Chinese equities could broadly perform in a similar manner for the next 3 to 6 months. But yes, if we start seeing tangible impact of stimulus measures in China, then that could be a better point of time to reassess adding allocation to Chinese equities.
Okay, all right. Abhilash, good talking to you. Thank you very much for stopping by at short notice. Really appreciate it given the way the market's behaving today. Thanks for joining in. We will take a quick break on that note.